You start at level 1 with $340 in checking and a phone full of real estate podcasts you've listened to at 1.5 times speed on the drive to a job that doesn't pay you enough to invest in anything. No deals closed, no investors, no track record longer than the spreadsheet you built last night at 11 p.m., the one with a tab labeled Deal Flow that has nothing in it yet. This is the part nobody puts in the reel. Everyone shows you the $250 million portfolio, the skyline view from the boardroom, the private jet shot with the caption about vision. Nobody shows you level 1, where you're cold emailing brokers who don't answer, where you're the guy asking a 62-unit seller to trust you with $4.8 million when you've never signed a single closing document in your life. At level 1, nobody owes you anything. No investor wires money to a stranger. No lender underwrites a track record that doesn't exist. You are functionally invisible in an industry that runs entirely on proof, so you build proof the only way you can. You start treating this like a game with levels, because that's the only framing that keeps you moving instead of freezing. Level 1 has one objective and one objective only: source a deal good enough that people forget you're new. Here's where it stops being a hustle culture platitude and starts being math. You can't out-capital anyone at level 1. You can't out-network a guy who's been to every CRE happy hour in the metro for a decade. But you can out-analyze them because most brokers and most small operators are still running comps by memory and gut feeling, and you're running an AI model against every off-market and on-market listing in a 40-mile radius before your coffee's cold. You feed a rent comparison tool every multifamily listing in 3 zip codes, and it flags a 24-unit building 15 minutes outside downtown, listed at $2.1 million. That's been sitting for 61 days because the seller priced it against gut instinct instead of actual trailing 12-month numbers. The AI pulls the county tax record, cross-references rent rolls scraped from a property management portal, and shows you something the listing agent didn't bother calculating. Units are renting $180 under market. Occupancy's been artificially propped by 2 long-term tenants who'll likely leave within the year, and deferred maintenance is masking about $340,000 of forced appreciation sitting there waiting for anyone patient enough to run. The numbers, you didn't find this because you're smarter than every investor in the metro. You found it because you automated the boring part of finding it. You run the same model against 40 other listings that week. Most are noise, one isn't. That's level 1 in a sentence. Using AI to compress 6 months of manual market scanning into 6 days so that by the time you actually talk to the seller, you already know more about his building's economics than he does. But knowing the deal is real doesn't make you the guy who closes it. You have no capital, so you structure the smallest version of a syndication that still functions as one, not the $50 million fund you'll run at level 4, but a scrappy, honest, single-asset deal. You need $525,000 in equity to close alongside a $1.575 million loan. You're not raising that from institutions. You're raising it from the 14 people who've watched you talk about this obsessively for 2 years and finally believe you might actually do it. You build what every operator before you built and never talks about out loud: the founding investor list. Your aunt who owns 3 rental houses and has been waiting for you to finally do something with all that analysis you keep doing for free. Your old college roommate who sold a small software company and has $40,000 sitting in a savings account earning nothing. A guy from your gym who mentioned once, almost as an aside, that he inherited some money and doesn't know what to do with it. You don't pitch strangers at level 1. You pitch the 14 people who already trust the version of you they've watched show up consistently for years, and you structure the deal so their check sizes feel survivable. $15,000 minimum, not $50,000, because level 1 investors need low-friction entry points more than they need upside. You put together a 1-page deal summary, not a 40-slide deck, because at this level, overpolish reads as compensation for something. Projected 8% preferred return, a 5-year hold, a conservative 14% target, IRR, comps pulled straight from the AI model so every number has a receipt behind it. You close on $538,000 raised from 12 investors, 2 of whom you'd never met in person before the wire hit escrow. The deal closes on a Tuesday. Nothing about the building changes overnight. Same 24 units, same tenants, same deferred maintenance sitting exactly where it was. But something else changes completely. You're no longer the guy who talks about real estate. You're the guy who closed a $2.1 million multifamily acquisition using a capital stack you built from nothing but a spreadsheet and 14 relationships. That's the unlock, not the money. $538,000 doesn't make you rich, doesn't even make you comfortable. It's the credibility compounding underneath it. The next broker who takes your call takes it because you're a closer now, not a caller. The next investor who considers wiring you money considers it because someone in his circle already got a distribution check with your name on it. You've just cleared level 1, and the account balance still says $340. But the game board underneath you has completely changed shape, and you're about to find out that level 2 isn't about finding one good deal anymore. It's about proving you can find them on repeat, at speed, without breaking. Level 2 starts with a problem level 1 never prepared you for. The 24-unit deal worked, and now everyone wants to know what you're doing next. That's the trap nobody warns you about. One deal makes you interesting. 2 deals, spaced 18 months apart because you're manually underwriting every listing at midnight after your day job, make you look like a guy who got lucky once. The gap between those 2 outcomes is entirely about repeatability, and repeatability is the only thing that separates a syndicator from a guy who closed a deal. So you stop treating each acquisition like its own project and start treating deal sourcing itself like a system. You take the AI underwriting model you cobbled together for that first 24-unit building, and you rebuild it as a pipeline, not a one-time tool. Instead of manually pulling comps for 40 listings, you set it to run against every multifamily property hitting the market across 5 metros, pulling tax records, rent rolls, permit history, and crime data automatically, then scoring each deal against your buy box before you've even opened your laptop. What took you 6 days at level 1 now takes 40 minutes. You're reviewing 12 fully underwritten deals over coffee instead of chasing one deal for a month. The math starts moving fast once the pipeline is running. You go from evaluating 4 deals a quarter to 60. Most still get rejected in the first 90 seconds because the model is doing the filtering you used to do by hand at 1 a.m., squinting at a spreadsheet. But out of 60, 3 or 4 are real. That's not because you got smarter. It's because you stopped being the bottleneck. Deal number 2 is a 41-unit building in a suburb you'd never even driven through, flagged by the same AI model because occupancy had quietly dropped 11% over 8 months while rents in the surrounding submarket climbed 6%. The seller was a retiring owner who hadn't touched the rent roll in 3 years. You raise $890,000 across 19 investors this time, 7 of them brand new. People who found you because your first 12 investors couldn't stop talking about the distribution check that landed exactly when you said it would. That's the thing about level 1 done right. It doesn't just close a deal, it manufactures word of mouth you didn't have to buy. But closing faster creates a new problem almost immediately. 19 investors want updates, then 31, then by deal 4, 58 investors are asking the same 6 questions every month. What's occupancy? What's the distribution? When's the next report? Is the roof project on schedule? You used to answer these one email at a time, which meant an entire Sunday evaporating into investor relations instead of sourcing the next deal. That's not scaling, that's just a slower version of level 1 with more people watching. So you automate the communication the same way you automated the underwriting. You build a reporting system that pulls live occupancy numbers, distribution schedules, and CapEx progress directly from your property management software and drops it into a personalized monthly letter for every investor automatically without you touching a keyboard. An AI drafting layer handles the narrative tone so it doesn't read like a spreadsheet dump, and you spend 20 minutes a month reviewing the output instead of 11 hours writing it from scratch. 58 investors get a report that feels handwritten. You get back a Sunday. That's the actual unlock at level 2. And it's not glamorous enough to make it into anyone's reel. The hours you get back from automation are the hours you reinvest into sourcing the next deal. Every hour you don't spend formatting a PDF is an hour spent on a call with a broker who's sitting on an off-market 60-unit nobody else has seen yet. Capital starts moving differently once investors can see the system instead of just trusting your word. At level 1, you were pitching people who believed in you. At level 2, you're pitching people who can see 4 deals, 4 sets of distributions landing on time, and a reporting process that looks more institutional than half the funds 20 years older than you. That credibility lets you raise $2.4 million for deal 5 from 31 investors in under 3 weeks, 9 of them wiring 6-figure checks they'd never have sent a guy with one closed deal and a 1-page summary. The system is the pitch now. You're not selling a building anymore. You're selling proof that the machine behind the building works. Here's the part that trips up almost everyone at this stage: the instinct to hire fast. More deals, more investors, more reporting feels like it demands more people. You resist it, mostly because you can't afford not to. Instead of hiring an analyst, you deepen the underwriting model. Instead of hiring an investor relations coordinator, you deepen the reporting automation. Instead of hiring a full acquisitions team, you hire one sharp analyst and let AI do the work of three. Your headcount stays at 2 people through 11 closed deals and $14 million in raised equity, because every task that would have required a new hire 2 years ago is now a workflow that runs while you sleep. Then you hit the tipping point nobody tells you is coming. Deal flow starts outpacing what even the automated pipeline can hand you cleanly. You're closing on properties faster than you can personally walk every unit. Investors are wiring capital faster than your 2-person team can manually confirm every transfer. The system that felt like overkill at level 2 starts feeling like the bare minimum at level 3, and you realize the ceiling you thought you'd never hit is actually just the floor of the next level entirely. Level 4 doesn't announce itself with a party. It announces itself with a phone call from a name you don't recognize, a woman named Odalise Farrow, who manages allocations for a pension fund out of Ohio, asking if you have a data room. You don't have a data room. You have 11 closed deals, $14 million raised, and a Google Drive folder named Investor Stuff Final V3. That call is the moment you realize the game changed underneath you sometime in the last 6 months, and nobody sent a memo. Here's what actually happened. Somewhere between deal 11 and deal 17, your track record stopped being a story you told and started being a dataset someone else could pull. Every distribution that landed on time, every occupancy report that matched what you promised, every CapEx project that finished under budget got logged, timestamped, and quietly compounding into something that looks, from the outside, like institutional discipline. You weren't building a reputation. You were building a track record, and those are not the same thing. A reputation is what people say about you at a dinner party. A track record is what shows up in a spreadsheet when a pension fund's due diligence team runs your name against every deal you've ever closed. But before institutional money shows up, the portfolio itself has to change shape, because a single asset class in 5 metros is a rounding error to a fund like Odalise's. And it's also the exact profile that gets wiped out by one bad submarket. So at level 4, you stop being a multifamily guy and start being a portfolio operator. You add a 96-unit garden-style property in Charlotte, a 34-unit boutique building in Kansas City that's technically mixed use because the ground floor has 3 retail bays you didn't want but inherited anyway. And your first industrial flex deal, a 140,000 square foot warehouse split into 11 bays outside Nashville that has nothing to do with apartments at all except that the underwriting logic, cash flow against risk against replacement cost, turns out to translate almost perfectly once you rebuild the model's assumptions. That's the real shift. You're not managing 4 properties in one market anymore. You're managing 40 properties across 6 markets and 2 asset classes and manually tracking correlation risk. What happens to your entire portfolio if Charlotte's job market softens the same quarter Nashville industrial vacancy ticks up is not a spreadsheet problem anymore. It's a modeling problem. So the same AI pipeline that used to just flag underpriced multifamily listings gets rebuilt again, this time as a predictive layer that's constantly scanning permit filings, employer relocation announcements, population migration data, and interest rate sensitivity across every market you're in and every market you're not yet in, scoring not just individual deals but the health of your entire portfolio's exposure in real time. It flags, 6 weeks before anyone at a regional bank notices, that a manufacturing plant closing in a secondary Texas market is about to soften rents on a property you're underwriting there, and you walk from that deal before you're $2.1 million into it. Nobody claps for the deal you didn't do. That's the point. Leverage is where most people start bleeding at this stage, and it's not because they're reckless. It's because debt that worked beautifully at $14 million behaves completely differently at $60 million. A single loan going sideways on a $2 million deal is a bad quarter. A single loan going sideways on a $60 million portfolio, cross-collateralized the way lenders love to structure it because it's easier for them, can take 4 unrelated properties down with it if you're not deliberate about how the debt is laid out. So you start staggering loan maturities on purpose, spreading them across different lenders instead of consolidating with one relationship bank that would happily hold your entire portfolio's risk in exchange for a better rate, and you keep leverage on any single asset capped well below what the lender would actually approve you for, because the goal stops being how much can I borrow and becomes how much can this specific asset survive losing before it drags something else down with it. That discipline is boring. It's also the only reason funds at this size don't implode the first time a market turns. This is roughly the point where a book like the one I put together for this exact stage earns its keep. Honestly, it walks through the debt structuring models and the predictive scoring frameworks in a lot more depth than I can cram into one video, and it's discounted this week if you've been following along and actually want the mechanics behind what's happening on screen right now. worth grabbing before the price goes back up. Institutional capital doesn't show up because you're big. It shows up because you're legible. Odalise's fund doesn't care that you closed 40 deals. She cares that every one of those deals reports the same way, underwrites the same way, and survives the same stress tests her analysts run against every other operator in her pipeline. You pass, and the first check isn't glamorous. $4 million into a fund vehicle you had to restructure your entire entity setup to accept. But it's the first dollar that came from a spreadsheet instead of a relationship, and that distinction matters more than the number does. Here's why most syndicators never make it past this level. Everything that got them here, the hustle, the personal relationships with 60 individual investors, the instinct to underwrite every deal themselves because they don't trust anyone else's eye, becomes the exact thing standing between them and the next $50 million. Institutional capital doesn't want a founder who still reads every lease personally. It wants systems that don't depend on you being awake. Most operators can't let go of that control, so they plateau right here, permanently running a very profitable $30 million business while telling themselves they chose to stay small. The ones who break through do the thing that feels wrong the first time. They let the system run deals they never personally touch, and they watch, half terrified, as it performs exactly as well without them in the room. Level 5 doesn't feel like an ending. It feels like a Tuesday, except the Tuesday includes a call from a placement agent in Zurich asking whether you'd consider a continuation vehicle for your first 3 funds, and you have to Google what that means before you call him back. $250 million isn't a number you hit. It's a number you look up one afternoon in a consolidated reporting dashboard and realize you sailed past sometime during a quarter you were mostly thinking about something else entirely. Here's what the machine looks like at this size. You're no longer running one AI pipeline. You're running a stack. One layer scores acquisitions across 14 markets and 3 asset classes, weighting not just cap rate and rent growth, but correlation risk against everything else already in the portfolio. A second layer manages investor relations at a scale that would have taken 40 people a decade ago, personalized quarterly letters, automated capital call sequencing, K1 generation that used to eat 6 weeks of your accountant's life and now takes 4 days. A third layer, the one you're proudest of, runs continuous stress tests against the entire $250 million book, simulating what happens if rates move 150 basis points, if a top 5 market softens, if your largest lender tightens covenants, and it flags exposure before your CFO's morning coffee is cold. You're not managing properties anymore. You're managing a portfolio of systems that manage properties, and your actual job most days is deciding which alerts deserve a human in the loop. This is also the level where the word exit stops meaning what it used to mean. Early on, an exit was selling one property and distributing the proceeds. At $250 million, exits are engineered, not stumbled into. You're running recapitalizations on your oldest fund, Fund I, the one that closed 6 years ago on $6 million and 11 investors, rolling the strongest performing assets into a continuation vehicle so your original LPs can cash out at a premium if they want liquidity, or roll forward if they want to keep compounding. You're structuring a fund-of-funds arrangement with 2 smaller syndicators you mentor now, allocating a slice of fresh capital into their deals in exchange for a piece of their carry, effectively turning your platform into an allocator as well as an operator. None of this existed in your vocabulary 3 years ago. All of it is now Tuesday afternoon paperwork. And this is exactly where the mistake happens. Not at level 1, when you're too small for it to matter. Not at level 4, when Odalise's due diligence team would have caught it. It happens here, at the size where you finally have enough moving pieces that nobody, including you, is watching all of them at once. The mistake is deceptively boring. You're running multiple funds simultaneously now, Fund I winding down, Fund 2 fully deployed, Fund 3 raising, and a great deal comes across your desk, a 220-unit value-add property in Raleigh that your AI pipeline flags as a top decile opportunity. The question that should take priority over everything else is, which fund gets this deal? And if you don't have a locked, written, sequential allocation policy decided in advance, that question gets answered informally, in real time, under deal pressure, by whichever fund happens to have the most available capital that week. Or worse, by whichever fund happens to carry your largest personal promote. You don't do this maliciously. Nobody does. You do it because you're moving fast and the deal is good and somebody has to get it. But the moment you make that call without a documented policy behind it, you've created a fiduciary conflict between 2 sets of LPs who both trusted you with the exact same thing, that you'd treat their capital identically to everyone else's. It doesn't surface immediately. That's what makes it dangerous. It surfaces, on average, somewhere between 14 and 18 months later, usually when Fund 2's investors start comparing notes with Fund 3's investors at this same investor summit you host every spring. Or when a routine SEC exam pulls your allocation history and asks you to explain, in writing, why 3 of your last 5 best-performing deals all landed in the fund where you personally hold the largest carried interest. By then, it's not a conversation. It's a legal exposure, and the fix, retroactive reallocation, LP notifications, possible clawbacks, regulatory legal fees, routinely runs into 7 figures before it's resolved, not counting the thing you can't put a number on, which is every future fundraise happening under the shadow of investors who now read your allocation memos with a lawyer on speakerphone. The syndicators who never see this coming are almost always the ones who scaled fastest, which is its own quiet irony. Speed got you from $0 to $250 million. Speed is also exactly what skips the boring step of writing an allocation policy before you need one. Look at the whole climb for a second. Level 1 was you sourcing one deal off-market with a scraper script and a cold list nobody else was calling. Level 2 and 3 were systems, capital, and automation replacing you as the bottleneck, turning a one-person hustle into something that could raise without you personally closing every investor. Level 4 was the shift from reputation to track record. The moment institutional money started treating your deal history as a dataset instead of a story, and the moment leverage stopped being a tool and started being a risk you had to architect around. And Level 5 is here, $250 million deployed, AI running the acquisition, reporting, and stress testing stack simultaneously, and the single quiet mistake sitting underneath all of it, waiting 14 to 18 months to become a lawsuit. That mistake, the exact allocation framework that prevents it, and the legal language every multi-fund operator needs in place before their second fund even closes, that's the part I couldn't fit into this video, but I did put it all into the book. Links in the description. Go read it before you're the one explaining a deal allocation to a lawyer instead of an investor.